Good morning, good afternoon to all of you. On behalf of the entire Lombardy team, it is a great pleasure to welcome you to this January 2022 edition of our Rethink Perspectives in what is a live broadcast from our headquarters in Geneva, Switzerland. Today, we will be several members of the Lombardy team participating to that session. So let me start by introducing them to you. First, we have the great pleasure to have with us Stéphane Monnier.
Good morning.
Stéphane, who is a partner of the firm, who is our Chief Investment Officer for our private client activities. We also have the great pleasure to have Sami Shah.
Hello, hello. Very happy to be here.
Sami, who is our Chief Economist, as you know. And we also have a new face I would like to introduce you to this afternoon, in the person of Fabrice Adrien.
Good morning, Frédéric. Good morning to all. Thank you for joining.
Fabrice, who is heading our investment advisory team within our private client unit. We're now in January 2022, which means that it has been almost 2 years now for all of us that we have been living with the consequences of the COVID pandemic. On the healthcare front, things seem now to be going in the right direction. The vaccination rates are progressing. The virus continues to come up with new variants, yet for the time being, healthcare infrastructure is holding up, and we will all likely be able to avoid any further hard restrictions. On the political and economical front, we feel that we continue to live in a world of experimental economics. Over the past 2 years, we've witnessed the implementation of massive programs of support by government and central banks. And if we look at the US and the example of the Fed, just for the past 2 years, it has put rates down to zero, has more than double the size of its balance sheet. It continues to be conducting QE every single month. Now, what have been the consequences of all these measures? First, the threat of depression has been averted. Second, most economies have experienced a very strong V-shaped rebound. Across the developed world, most economies are now back to their long-term growth trajectories. And as we know, equities markets have reacted positively to this, closing in positive territory in 20 and 21. Now, this is all very encouraging, yet at the same time, we can all feel it. This year, 2022, is starting with a lot of nervousness and anxiety across markets. Now, if markets are more volatile, we feel this is largely because we're entering into a new phase of the cycle. If the first phase was very much about crisis management and support, we feel this new phase is going to be much more about normalization and the removal of that support. And we certainly think that this new phase is likely to be fraught with uncertainty and some volatility, especially at a time where many of the central banks will be normalizing their support, will be removing some of the most accommodative parts of their policies. We feel that markets will naturally have to adjust to that new reality. So this session is about rethinking together what this new reality could bring, sharing with you our perspective on the current economic and market environment. We propose to do it in a very dynamic and interactive way. So we'll do it in the form of a panel. Will be moderated by Fabrice with Stéphane and Sami. We'll want to review all the key questions of the moment. What is the pulse of the economic recovery? What are expectations with regards to inflation development? How do we look at central bank monetary policies? We will also look at China, especially perspective on growth and various Chinese asset classes. Sami will talk more about the macroeconomic angle. Stéphane will talk about investment strategy and portfolio positioning. In a second part, we will be taking your questions. So during the full session, you're all cordially invited to send us your question. Fabrice will group them by theme and we'll put them back to Stéphane and Sami. Thank you very much to all of you for your attention. And I'm very happy to hand over to Fabrice.
Thank you very much, Frédéric, for laying out the context and the agenda of this session. We'll try and make it as interactive as possible indeed. So in this turbulent period for markets that you mentioned, Frédéric, might make sense to take maybe one step back and put things into some kind of perspective by figuring out, maybe to start with you, Sami, where the current economic activity globally stands and at which phase of the cycle we currently are in the ebb and flow of the COVID. So please take it away.
Thanks so much, Fabrice. So yes, indeed, a couple of first thoughts on where we are when it comes to this economic expansion. The first observation is that our economies continue to go through a very severe pandemic wave when it comes to new cases. This is not the first wave we're facing. It's the fifth or fourth, depending on the different economies. But what is a bit different with this Omicron wave is the disconnect we see between a very high level of cases, but a relatively contained level of fatalities. So the pressure on the hospital system and the economic system is maybe milder than what we have seen in the past. The second observation is that, as we see here, this is not the first wave. We've learned a lot from the previous wave. And what is very striking is that the impact on the economy is milder and milder. So we continue to monitor a very widespread set of economic indicators, and they are holding relatively well in the face of the wave. And once the wave passes, because that's also an observation, at some point this wave, they pass, there is then a catch-up effect. So overall, economic performance remains decent. And this is exactly what we're trying to show here on this page. The dark line that you see here is a composite indicator where we put everything we have when it comes to what we're looking at: high-frequency data, trade data, housing data, consumption data, production data, employment, and we plot that against the clear line, which is world growth. And what you see is that we had a very strong year in 21, which is what was the resurrection year from the COVID shock. And now we are slowing, but to relatively decent levels, where basically all our indicators point to world growth being around 3.5% to 4%, which is close to the level it was pre-COVID. So something that remains relatively acceptable. We are still in an expansion, and that expansion is going on at a relatively favorable pace.
So with that in mind, then, thank you, Sami. And turning to you now, Stéphane, how does this landscape translate into the corporate profit cycle? And what does it mean for equity markets in particular? Is there still room for positive returns going forward? And if so, in which segments specifically?
Thank you, Fabrice. So like Frédéric was hinting in his introduction, you know, the beginning of the year has been quite brutal in terms of stock markets. If we start with the US, you know, the S&P 500 has lost year to date something like 8%. The Nasdaq has lost 13%. And then if we move closer to Europe, you know, we have lost something like between 5 and 6%. China has lost between 3 and 4%. So quite a negative start of the year. And then, as usual, you know, this creates, I would say, volatility. And volatility that we like to look at, one indicator is the one that we call the VIX, which is basically the fear index. Historically, the value of the VIX is on average around 20. You know, before the start of the year, it was at 17. During this crisis in early January, it went up as much as 39 and is currently at 31. So you can see that the markets are a little bit worried. So what is our attitude? Should we, you know, hedge the portfolio or be more defensive, or should we, on the other hand, you know, stay invested in risky assets, which is our recommendation? And to answer that question, I would like to go back to the fundamentals. And Sami is forecasting an economic growth for the world between 3.5% and 4% this year. This is not very different than the prediction from the IMF itself, which has just revised down its forecast for growth in 2022 at 4.1%. And what I would suggest is let's look what happened in terms of corporate earnings in the past when you know, we have had growth between 3.5% and 4%. And that's what you can see on the chart on the left of this page, where the bars represent the increase in the corporate earnings. And on the x-axis, you have various rate of growth. And you see the one before last is the rate of growth between 3.5% and 4% for the global economy, which usually translate in an increase in corporate earnings, not very far from plus 15%. And when we say that to our clients, usually they say, well, Stefan, don't you think equity valuation are very expensive? And the way we answer this question is on the chart on the right. So basically, you see a gray line at the bottom of this chart, and this shows the evolution over the last 18 months of the PE. And you can see that the kind of valuation of equity has not changed much over the last 18 months. If you look at the black line, it represents the performance of the S&P 500. And this performance has been stellar, as we all know, in 2021. And the dotted line, which is close to it, represent the evolution of the earnings. And you see that basically the good performance of the S&P 500 in 2021 was totally explained by the increase in earnings for that year. So clearly we are expecting less growth in earnings in 2022 than we have had in 2021. However, we still expect something between plus 10 and plus 15%. And therefore, we do expect a performance of the S&P 500 to be between plus 5 and plus 10%, in 2022. And that's why we are slightly overweight in equities. When I say that we are positive on equities, clearly all equities are not equal. We are expecting quite a lot of differentiation between different sectors. Some has already happened since the beginning of the year. You know that technology stocks have lost more than the rest of the market. How do we explain that? Here, I would like to introduce the concept of kind of a duration of an equity. Basically, if you look at value stock or cyclical stocks, they tend to have their cash flows and their earnings quite regular in time. So a reasonably high proportion of their earnings are in the coming years, which is different from the tech stocks or the growth stocks in general, who tend to have their cash flows and their earnings much more positioned in the future. Therefore, when the cost of capital goes up, which is the case since the Fed mentioned the fact that they will raise rates in 2022, this has more impact on long cash flows because and hence it penalizes the tech stock versus the value and the cyclical stocks. Another way of looking at it is what you see on the chart on the left on this page. You see that we plot the break-even inflation evolution, and clearly this has been a leading indicator in terms of overperformance of value versus growth historically, and this explain the current situation. Also, at the beginning of the year, value stocks were much less highly valued than tech stocks. We think there's been a catch-up being done until now, but we don't think this is completed yet. We think there's maybe another third of the way to go. And therefore, we would recommend currently to be exposed more to value and cyclical stocks. But we think we could start to think about reinvesting in some of the tech stocks, especially the companies that do generate cash flow and earnings in the short term.
Right. So still some potential, but not to the same extent across the board. So let's now turn to the risk side of the equation, and in particular, inflation that Frédéric mentioned in his introduction. Sami, it seems increasingly clear that the inflation dynamics are alive and well, judging by the latest data. So should investors be concerned not just for the short run, but also for the medium term?
Thanks, Fabrice. Well, the way we see it is that everything that could have generated inflation has generated inflation at the same time, and basically at the same place in the second half of 2021, which is essentially the US. We saw a lot of inflation elsewhere, but not as much as what we saw in the US. And basically both supply side dynamics and demand side dynamics generated price pressure again at the same time. So on the supply side, there is obviously the cost of shipping that we see here on this page, that contributed a lot to price pressure, the transportation of goods from the producer to the consumer in the second half of 2021. There are other supply side elements like the bottlenecks on microprocessors, but also energy goods that were on the high side. So the supply side dynamics are starting to ease. This is exactly what we see here on this page, with the cost of shipping going extremely high in the second half of 2021 and now basically reverting to more normal level. It's the same story with microchips. The Asian manufacturing plants are open in Vietnam, in Taiwan, in Malaysia. So we're starting to see the automakers being able to produce cars. That is limiting some of the price pressure. And when it comes to energy goods, the oil price is high. But for now, despite the geopolitical tensions, European gas, Chinese coal, from which they draw their electricity, all this has came to more reasonable levels. So overall, on the supply side, the pressures that generated inflation in the second half of 2021 are starting to ease. What's also interesting is on the demand side, as we try to show here, a lot of the inflation comes from the fact that they were very generous fiscal support schemes during the pandemic shock to offset some of the income shortfall. So what we show here on the vertical axis is basically the amount of fiscal stimulus that was put in the system during the shock. And then on the vertical axis, we basically show how that translated into higher inflation when we strip out energy goods. And you see that basically there is a correlation between the amount of stimulus that was put and the level of inflation that we have now. No one generated more stimulus than what we saw in the US, 25% of GDP in terms of fiscal impulse that generated 5.5% core inflation. If we look at the rest of the world, in the UK, obviously, it's a bit the same story as the US. A lot of stimulus led to currently higher inflation. But in Europe, inflation, when you strip out energy cost, is around 2.5%. It's 2% in the Middle East. It's 2% in China. It's only 0.8% in Switzerland. And it's still deeply negative in Japan. So the story is not equivalent everywhere. Americans' households received pretty decent checks that, again, they spend in goods, which generated inflation. This is unlikely to repeat itself in 2022. And so therefore, this year, we still expect decent inflation from wages, from rents, but certainly not as high as what we saw in the second half of 2021. So the picture should improve going forward with more benign levels of inflation by the end of 2022.
So quite mechanically, inflation should abate over the course of the year. Now, Stéphane, should investors learn or relearn how to live with inflation? And what does it entail in terms of portfolio diversification? And should we find or explore sources of inflation protection for our portfolios?
Thank you, Fabrice. So as Sami is telling us, the inflation is going to go down in 2022, but it is going to stay at a relatively elevated level compared to what it was historically. So it might make sense, to part of your portfolio to be protected against inflation. And in order to protect yourself against inflation, right now, there are three types of asset class that we can recommend. The first one is floating rate notes. Basically, they are indexed on short-term rates that evolve with time, and hence their coupon increase when rates go up. So you have the typical liquid one, which we recommend that you could also have them in terms of loans. The second part of the asset, or the second type of asset class that we can recommend are inflation-linked bonds. They do exist in most developed markets. They are called TIPS in the US, linkers in the UK, OATIs in France. You have them also in Germany and so on. So this is an asset class that kind of, which returns is really related to the evolution of the inflation. And last but not least, and probably the one we currently favor in our client portfolios, is real estate. Indeed, most of the rents that are perceived by landlords are indexed to inflation. So if inflation increases, it improves the return that you get on your rents, and that's something that is favorable in this case. So these are the three asset classes that we would recommend. There is another element that I want to point out, which is how climate transition will be managed, and this might have a big impact on energy prices going forward, and also on inflation. As you know, we are trying to produce less carbon emission in the world, so we are trying to get away from fossil fuels and more into renewable energy. And I think what happened last winter or in Europe, I mean in 2021, in the later part of 2021, was the fact that there was a big economic rebound, as Sami has explained, but on the other hand, the capacities in terms of renewable energy were not sufficient. This has created an increase in price of coal, in price of gas, in price of oil, that is illustrated on the graph that we are currently showing. Clearly, there has been also some geopolitical interference with the crisis in Ukraine and sometimes, issues in the Middle East that have also made the price of energy go up. But the lesson that we have to learn from that is that, both the government, the corporates, and the investors need to play their role so that it doesn't become a structural issue. You need the government to put in place the right investments in terms of infrastructure. You need them to have the right regulation. You need the corporates to adapt their business model, to the climate transition. And you need the investors to finance also this energy transition. If not, energy could be a source of inflation for quite a while.
That's a great segue to the next section around stimulus, precisely. Both Sami and Frédéric already alluded to. So, Sami, is the tide turning on both the monetary and the fiscal fronts? We have a Fed meeting today. Central banks have been the elephant in the room. What's your reading on economic policy by and large?
Well, yes, Fabrice, the tide is turning. Is it an issue? Not necessarily. So Frédéric did mention that markets were nervous and it is normal, but considering the 2 points that we've just made, one, that the economic expansion will continue, albeit at a lower pace, but still at a decent pace, and cyclical inflation eventually becoming more benign, but still being present, it does mean that the economic environment is getting better. And so it is pretty natural that central banks and governments start removing the emergency measures that they've put in place during the shock. Is it a problem? Well, this is not the first tightening cycle that we've been through. After every crisis, there is a response, and then there is a normalization of that response. And this is exactly what we see here. We are at the beginning of the tightening process, not at the end. This is just the first hikes that we will meet this year. If you think about the previous hiking cycle, which you see in the middle of this page, the Fed engineered 9 rate hikes in the previous cycle. And as we see today, there was a bit of volatility at the beginning, but the economy is strong enough to support, I would say, less accommodative monetary condition. And this is exactly what 2022 is about. The Federal Reserve and other central banks currently are super accommodative. And with the actions that they will take this year, they will go from super accommodative to just accommodative. Now, maybe later in the cycle, they will shift from being accommodative to neutral, and then from neutral to being restrictive. And this is when problems arise, right? This is when the margin of safety shrink. But we're just at the beginning of the process. We're shifting from super accommodative to just accommodative. As we show here on this page, real rates, long-term real rates are still deeply negative, which means that the cost of capital remains favorable. Yes, less favorable than last year, but nonetheless, still favorable. And however we look at it, monetary and financial conditions remain far from restrictive, which means that this continues to be a tailwind for economic activity and for markets.
So there's a nuance between less accommodative and restrictive, indeed. So With this phasing out of stimulus, nevertheless, Stefan, and asset valuations, you mentioned them at fairly high historical standards, isn't there a risk of a scissor effect on risk assets? Should investors stay calm and carry on, or should we start protecting some portfolio gains tactically at least?
As Sami is telling us that, probably the first rate hike from the Fed will happen, at the end of March this year, I thought it would be interesting to look at history and see what usually happens when you compare, market performance versus this point at which the central bank hike rates. So this is what is represented in this bar chart. And you see there are 3 blocks of bars. So if I concentrate on the left, this is the equity performance in the 6 months prior to the first rate hike. So the period that we are currently in. And as you can see, the equity performance is negative. So the kind of correction that we have seen in January, maybe, is not a surprise. Maybe it's a bit stronger than the numbers that you see here. But, clearly the 6 months are not finished. So there could be a rebound between now and the end of March. But then when you look at the following set of bars in the middle, you see that for the 6 months following the first rate hike, if we take history as a guide, clearly the performance is positive. And this is also confirmed 12 months after the first hike, which is shown on the right side of this chart. So that's kind of, the information that history gives us. Typically, rate hikes are not so negative for equity performance. Now, when we kind of built our outlook for 2022, we said that there will be a lot of volatility in 2022. And I must say we have not been disappointed with the start of the year. Maybe it came a little bit with more strength and more rapidly than we would have expected. But how do you play volatility as an investor? And first, in terms of our positioning for our client portfolios, the good news is that, in the last quarter of 2021, we have rebuilt some cash buffer. Having cash in your portfolio is quite handy when volatility comes, because it allows you to take advantage of correction in order to buy risk asset at a cheaper price. And this is something that we may do in the coming months. The other element is related to volatility. I mentioned in my first comment the VIX, which is the fear index. And typically, the type of strategy that we will recommend is when the VIX is pretty low, let's say below 20, we will recommend to sell calls in order to generate some additional income in your portfolio. Conversely, when there is, I would say, a low volatility, so below 20, then what you want to do is protect your portfolio. And here you should buy put or buy put spreads. And this will allow you to create an asymmetrical profile for your portfolio, which comes quite handy.
So we definitely recommend to stay invested, but nimble given the higher volatility regime we will certainly be facing. So the last topic we wanted to cover today was another blue whale in the markets, which was China, which definitely caught by surprise investors in the past few quarters. So, Sami, do you believe the worst is behind us, or is it yet to come? What's your overall sentiment on China?
Yes, definitely, Fabrice. There has been a huge change of narrative when it comes to China. China was basically the 2021 macro risk alongside inflation, as we've just discussed. China had a very, very restrictive stance in 2021, trying to control the credit cycle, control the property sector, control the tech giants, and control the education sector. So we saw quite a material growth slowdown in the second half of 2021. 2022 is a totally different year when it comes to the Chinese environment. There are two very important events in China in 2022, the Winter Olympic Games in Beijing in February, and more importantly, the 20th Congress of the Communist Party in November, during which Xi Jinping has to be re-elected for a third term, everything has to go well. And we see that change in tone from authorities here on this page, where, while the Fed has been extremely clear in its intent to start normalizing monetary policy, the Chinese authorities have taken exactly the opposite route, basically signaling much more accommodation to make sure that 2022 is a stable year. So they have cut the reserve requirement ratios twice already. They've cut the loan prime rate, which is the rate at which banks lend to the real economy. And then they've also cut the repo rate. I mean, the message is extremely clear. They want stability. They want growth between 5 and 5.5 this year. They want these two events to go well. And that is the support that is coming from the monetary side. But it is also joined with fiscal efforts, which is what we show here. Government bond emissions on the left-hand side here are on the rise. And on the right-hand side, you can see all the infrastructure projects that have been mentioned by the authorities in, again, a tentative policy to stabilize economic activity. So a U-turn when it comes to the Chinese macro risk. It was one in 2021. We believe that China no longer is a material macro risk in 22, as the authorities will do whatever they can to make sure that these two events that we've just discussed go well, and so a quite more supportive environment when it comes to China.
So probably less of a systemic risk indeed. Now, remains quite a bit of a wild card. So how should we factor in China, Stéphane, in our portfolio construction, both in terms of risk management and opportunity?
Thank you, Fabrice. So there are typically 4 types of investment that we can make in China. The first one is to invest in sovereign or quasi-sovereign debt. The second one is to invest in Chinese credit. The third one, of course, is Chinese equities. And then there is a question about the currency. And I will review them one by one. So if we start with interest rate and the sovereign curve, basically we have been overweight Chinese sovereign bonds for the last 18 months. And as you can see on the chart, it was quite a good position because interest rates have come down a little bit in China. And more importantly, the currency has appreciated. And this position was held against a short position in US Treasuries. And as you can see, the US Treasury yield has gone up. So what is remarkable about this is that this is very parallel evolution to the short-term rates that we have experienced in both countries, as described by Sami. And now the question is, when should we revert this position, sell our Chinese government bond to buy US Treasuries? We don't think we are at that point yet, but we think that around the level of 225, it should make sense to do that. So we might become, at some point, less positive on Chinese bonds. Now, the other segment of the market that we find interesting is the high yield segment in the Chinese market. You know that it has had a lot of difficulties in 2021, especially due to its high exposure to real estate. And there's been the famous Evergrande saga for the most of the 2021 year. This has resulted in a very sharp increase in yields. You have currently in the Chinese high yield market yields that are around 20% or slightly above 20%. In my professional career, the last time I've seen a yield at that level was during the corporate crisis in Europe following the financial crisis of 2009, and people that have invested in credit at that point in time, had very good returns. What I want to stress is that there might be some default happening in the Chinese high yield market, but when you are paid such a high premium with 20, 21, 22%, it can, in a well-diversified portfolio, I would say, withstand a few defaults if you are sufficiently diversified. The question of Chinese equity is also interesting. We were underweight Chinese equity for most of 2021. We came back towards neutral towards the end of the year. And the question is when we would become positive on Chinese equities. For the time being, we are so positive on Chinese high yield that it dominates from a risk-return perspective our view on Chinese equities. And for the time being, we are staying neutral. Last but not least, we are quite confident that the renminbi will be stable versus the US dollar. We just have to, I would say, be careful a little bit about the situation on this currency, because it's currently benefiting from a very positive balance of payment. And this very positive balance of payment could change if, the COVID pandemic will disappear somehow during the course of 2022, and Chinese, citizens will start to travel again and spend their renminbis abroad. That could have a negative impact on the renminbi, once that happens.
So quite a full set of opportunities we're looking at, and we're keeping in our radar screen. Thank you both. So before we move to the Q&A session, and thank you for the flurry of questions we've been seeing in the chat. We'll try and address as many as possible. Let me just leave you with a few key messages. One, we're transitioning to a stationary phase of the cycle and a normalization of macro policies. Two, as the pandemic gradually morphs into an endemic, market tail risks seem to be abating, and we have now entered a period of more cyclical risks we consider real but manageable. Three, in this context, market dynamics might be reshaped somewhat, but the upward direction of travel for risk assets remains, albeit probably at a slower pace. And last, in terms of portfolio positioning, to generate one return, we favor value and cyclical stocks. We want to capitalize on market volatility as well and dislocations through derivative and active strategies. Two, to shield portfolios, we focus on low duration exposures and tactical protection strategies. And last but not least, to provide diversification benefits to our portfolios, we rely on structural drivers such as China or sustainability trends. So with that, I suggest we take, I've bundled a bit the questions in different themes. There's one initial theme which seems to grab the attention and interest of our audience, which is around geopolitics, and specifically on the Ukrainian situation, which is quite timely. It seems to be hotter by the day. So what's your take, both Sami and Stéphane, on this for markets in general and the oil market in particular?
So perhaps I can start and then hand it over to Stéphane for the market implications. So first, our understanding of the situation is that the starting point is a negotiation between, on the one hand, Russia that would like to secure its borders, free from NATO and Western military presence. And on the other hand, Americans and the rest of the West wanting to, limit basically the Russian influence over the Soviet satellites. So it is a negotiation. For now, it is escalating. It is possible that we see Russia increasing its buffer zone in eastern Ukraine, but eventually trying to reunite the Donbas region and Crimea. And I think there are two scenarios. One where eventually it becomes clear that the Russian borders are secured, and therefore eventually we see mild sanctions around that. And obviously there is a risk scenario, which is a risk. I wouldn't say it's the base case as of now. There is still room for compromise, where eventually Russia gets deeper into Ukraine and would then face much severe sanctions from the West. So we continue to monitor the situation, but really what is at play currently is trying to find, the balance between how Russia needs to be secured and how the West needs to be reassured. Let's hope, they find a diplomatic path.
Maybe on my side, and as Sami is saying, we are still in the escalation phase of the, I would say, negotiation. And this is still something which is a little bit dangerous, because we need to find an issue to this situation with none of the parties losing faces. I think what is also important regarding this situation is to see that Europe is pretty much out of the table of negotiation, which is a little bit of a problem. So we have an issue here for medium and long run in terms of rebuilding, European diplomacy and European, I would say, security. And as far as this type of situation are concerned, there's always in this escalation phase a risk that something goes wrong. An incident can happen and can trigger a situation. So I think it's reasonably cautious. It's reasonable to be cautious and to protect yourself. And the best, I would say, edge in this type of situation from an investment point of view is probably to have exposure to commodities. And you know that in the context of a crisis, there are various types of commodities that would benefit. Energy is a clear one, but you have also some agricultural commodities that could benefit, such as corn or wheat, because Ukraine is obviously a big producer of those. So that's from an investment point of view. Clearly, all the Russian assets have already suffered quite a lot, whether we are talking about equities, bonds, or currency. They have been already negatively affected by this crisis.
Thank you both. So we have also a few questions on tech and growth stocks, generally speaking. With the recent pullback, in particular on the Nasdaq, is it time to dip back into tech stocks?
So maybe I'll take this one, Fabrice. I think that it depends which tech stocks we are talking about. I think it would be premature to buy, all tech stocks in an indiscriminated fashion. But if the question is to invest in, companies that have proven earnings and cash flows, I think it's advisable to start to look into them and maybe start to an investment program in tech stocks, because we are the conviction that tech stocks are very good for the long run, because that's where growth is going to be generated if you are taking a 5 to 10 year perspective.
Thank you. In reference to the description you made on the tightening cycle, we have two questions on its impact. Even though it might be progressive, should we fear some kind of civil unrest or even impact on public debt?
So perhaps I can start with this one. And it's a question that we indeed get a lot, the anxiety around the fact that we have a lot of debt and we don't necessarily know at what point the debt that we have might become too much. One thing that we continue to monitor is the interest payment out of the debt that we currently hold. And interest payments are extremely low compared to where they were in the 60 years post-World War II. So even if we have slightly higher rates down the road, basically interest payments are half of what they used to be. So we have much higher levels of debt, but considering interest rates are much, much below what we had in the past, the interest payment is actually remains favorable. You need to understand that countries have been taking debt, 10 or 20 years ago. They are rolling that debt at still much lower levels of interest rates. So it remains, I would say, a favorable environment for those who have debt. And the second point I would make, as debt is often seen as being a problem, I would tend to say that if it is invested the right way, debt could actually be part of the solution rather than the problem. We know that there are immense challenges ahead of us: an energy transition to finance, a digitalization to increase, and some social inequalities in our economic system. By using that resource that is debt, which is currently a cheap resource, and by investing it for the long term in infrastructure, in the social framework, that could actually be, again, a good thing. We need that energy transition to be done in a smooth way. We need investment, and a cheap source of funding of that investment remains debt. So it can, if it's invested wisely, be part of the solution. And this is what we hope for.
Excellent. Maybe we have a couple of minutes for a last question before we close. We received a series of questions around currencies, rates, or outlook. Perhaps, Stéphane, you want to give the helicopter view of our currency outlook, in particular regarding the dollar, the Swiss franc, and the euro, as well as the renminbi.
Sure, with pleasure. So, I mean, first, I would say this is a year where we don't expect a lot of volatility on currencies. I mean, in previous years, we have much stronger views on currencies, and we currently think that most of the currencies, if they are not at equilibrium value, they are not very far from it. But having said that, where we have a view is on dollar-euro. We think that dollar-euro is going to slightly appreciate, and we have a target of 110 for the dollar versus the euro. Now, if I move to the Swiss franc, we think that the Swiss franc is a currency that has a tendency to appreciate versus the euro due to the difference in competitiveness between the two economic zones. Switzerland is amazing in always improving its productivity, and therefore we think that the Swiss franc has a good chance this year to appreciate and reach parity versus the euro. As far as the renminbi is concerned, for the timing, for the next 6 months, we have a fairly I would say a stable outlook of the renminbi versus the US dollar, so an appreciation versus the euro. But on the other hand, we are, as I was mentioning in the Q&A session previously, there is a risk at some point that China reopens and that their citizens are allowed to travel, in which case it could play a slightly negative pressure on the renminbi.
Perfect. So unfortunately, we will not have time to cover all the many questions we receive. We'll make every effort to take them offline. So please also sign them for us to be able to identify who asked specifically those questions. And for the interest of time, let me now hand it back to Frédéric for some closing remarks.
Thank you very much, Fabrice. Thank you, Sami, and thank you, Stéphane. As Fabrice just mentioned it, if you do have a still question you would have liked to ask, you can send them to us, identifying yourself, or you can also always contact your banker and we'll make sure that we get back to you. Thank you very much to all of you who have joined us for that session. Thank you for your attention. As you know, analyzing and reviewing the market environment is always fraught with uncertainties and questions. So we look forward to be continuing to monitoring the markets, evolving our views. Watch this space. We'll continue to look forward to give you updates later through the year. Thank you very much. And on behalf of the entire Lombardy team, we wish you a very happy and prosperous New Year 2022. Thank you.